Welcome back, everybody. If you've invested for any amount of time, you've probably picked some bad stocks. Now, I've had my share of bad ones myself, and a lot were ones that didn't really align with my actual goals, but I just didn't really know it at the time, or they're companies that I thought were pretty good, but the stock just didn't perform. But there's one in particular that was the worst stock I ever bought, and I want to talk about that one today. Also, with the rumored acquisition of HubSpot by Google, people are again talking about the scrutiny that big tech is getting from all sides about how they're trying to use their growing cash piles. So we'll dive into what that means for investors. And finally, recent stock splits by Walmart and Chipotle have been in the news this year, and while they technically don't change anything from a value perspective, there's a pretty big reason why I loved that those companies did it. So we'll get into that as well. But let's go ahead and get started with the worst stock I ever bought. Now, believe it or not, my worst stock is one that I actually made money on. So then why would it be my worst stock? Because it was a terrible stock and a terrible company. And quite frankly, I really didn't know what I was doing at the time and I just got lucky. But that stock was Snapchat. I bought Snap in 2020 at various times, but starting in March. And then I sold it around August of that year. Overall, I had a gain of about $3,500, which was about a 17% increase. So all in all, I did pretty well. But obviously, had I held into 2021, of course, it went parabolic in the 2021 market craze. So I could have probably tripled or quadrupled the value of my holding. And that just shows how crazy 2021 was, because all the while, this was a bad company. And at that point, they hadn't even been profitable. And newsflash, they're still not profitable. Now, at the time, they didn't actually have any debt, so that was a positive, but they're constantly issuing shares and stock-based compensation that's diluting shareholders, all while not being profitable since they IPO'd in 2017. So then, why did I actually buy them at the time? And the short answer is I didn't know what I was doing. Because first of all, I was like, hey, it's only $11 a share, much cheaper than any of the other tech and social media companies. And that's because I had no idea of even basic stuff like market cap. And the fact that it's $11 doesn't really tell you anything. But obviously, around March of 2020, we were just starting the pandemic around that time. And there was a lot of uncertainty, obviously, but you figured that ad spend would continue to go digital and accelerate. And I had some anecdotal stuff, like my son was in high school at the time, and him and his friends were using it all day, every day. And pretty much anybody that I talked to under 30 was using Snapchat to message all their friends. So I thought, man, they have the young demographic. It's only $11 a share. Ad spend's going to ramp up. I mean, this is probably going to be a great investment. So obviously, as you can see, I didn't really dig into the company fundamentals pretty much at all. And this is a good point because a company can have a good story, they can have a good target audience, they can have good growth prospects, but how the company is run still matters. And that's why I have my 3 criteria that I use to evaluate stocks now: business, operational performance, and valuation, because it helps bring those things to light at the beginning of my research. And when you look at my strategy, it includes things now that help me weed out companies like Snapchat. I want companies with wide moats, ideally, or to put it simply, a competitive economic advantage that are generating increasing cash flow and rewarding shareholders with either dividend growth that outpaces inflation or share buybacks that increase their ownership stake in the business. Now, Snap is not generating cash flow, especially if you account for stock-based compensation. It's negative. They obviously don't pay a dividend, and not only have they not been consistent in buying back shares, but they've been increasing the number of shares just about every year, literally doing the opposite of what my strategy calls for. Now, they have done some buybacks over the past 2 years, but that was after they ramped up about $4 billion in debt on the balance sheet. So you can see how today, if I evaluated Snapchat, it wouldn't get anywhere near my portfolio because of how I set my criteria. And it was because of these experiences that I had in the past that made me do that. Which you might say, look, the company's only been public for less than a decade. Maybe they'll turn it around. And ultimately, I made money on the deal, so why am I complaining? And yes, I made money, but it was pure dumb luck. And just the fact that the market in 2021 was propping up these companies that had nowhere near that type of value. The only thing that saved me was that I actually sold it for a profit, because had I held on to it, obviously I could have made money up in the run-up in 2021, but had I been a, quote, good investor and held my investment till now, I would be actually negative 4 years later. But the biggest issue with Snap is that they're still doing the same things they were doing back then. They're still ramping up stock-based compensation at the expense of shareholders while not actually making an operating profit, and that's just not something that I can get on board with. And if you're wondering what actually made me think about Snap this week, years later, it was this news story about how they're addressing the latest controversy around one of their new features.
Snapchat is adjusting a ranking feature for paid subscribers that shows just how close you are to your Snapchat friends by displaying your position in what they call their solar system. This feature that basically says, are you Mercury because you're the person who's chatting back and forth and messaging back and forth with the most with this person? Or are you Uranus because you're the planet that is out in the coldest regions of the solar system? You're not that actively engaged with them. It's a feature that was criticized after a Wall Street Journal piece reported on the impact on teens' anxiety. In response to the backlash, Snapchat will turn the solar system feature off by default, and users will then have to opt into it if they choose to use it. And before this, it was the default that actually kicked in. I don't think this is a huge response. I think this is a way to say you're doing something without really doing something, because, again, it's a popularity feature that makes all these kids feel bad about themselves. We have seen the research on teens and the depression levels, a lot of that tied back to social media. If you actually want to do something about it, you should change it so you're not ranking and making them. Look, let's face it, this is a feature.
So you're not, I thought you were going to praise them for this.
No, you turned off the default and made it so it's not the default, but you've already got everybody keyed into it so that, yeah, we're already using this and we're going to do it anyway. And tell me that this is not a way to try and get kids to use the app more frequently. Because if you get to rank higher based on how often you're snapping back and forth with them, it's like the complete gamification. It's the way to try and make sure that you are keeping these kids using this app more and more frequently, which they, of course, they want to do as a business, but you're doing it at the expense of these teens' health. So it's a lousy, all of these popularity features are pretty lousy features, and you're jerks for doing it still.
So first off, Becky Quick is great. She's one of the few people in the financial news that I actually enjoy listening to, and I think she's spot on here. Of course, it's a feature to get folks to use the app more, and of course, they're a business and that's what they want to do. But it is kind of a sleazy way to do it, especially since their users skew younger, so they're much more impressionable. And when you combine that with the fact that they're still screwing over shareholders as well, it's just par for the course for Snapchat. So worst stock I ever bought, hands down, no competition. It did help me inform my future strategy, so I guess there's that. But anyway, let's go ahead and move on. The Wall Street Journal had an article this week about how big tech has a big cash problem. And the main point of the article is to talk about how the leading tech companies in the US, like Google, Apple, Amazon, Meta, Microsoft, and Nvidia, are sitting on a lot of cash. And even if you net out their outstanding debt, it still amounts to over $250 billion of cash. And on the surface, you might think, hey, that's a good thing. And for me personally, one of the reasons that I've been adding these companies into my portfolio in 2024 is because they have the ability to generate that much cash. And I don't see that stopping in the foreseeable future. So then what's the actual issue? The problem is that most of what they normally do with that money has become controversial or highly scrutinized by our government officials. For example, acquisitions are usually a place where companies spend money, but for big tech, acquisitions have become harder and harder to get approved, with constant scrutiny about antitrust, both in the US and abroad. So with Google's recent news that they're looking to acquire HubSpot, many people believe it has a low chance of success, or at a minimum, will take a very long time. And that's even with Microsoft's recent success with Activision Blizzard. But another place where they've utilized cash is through share buybacks, which effectively increase each shareholder's percentage ownership in the business by removing shares from the market, which also helps with metrics like earnings per share and meeting market expectations from quarter to quarter. But obviously, opinions on share buybacks are mixed, and in general, they can be both good and bad. Because ultimately, a share buyback is a decision by the company to use cash. And if they buy back shares at high prices, it's usually a poor use of their cash. But if they buy back at attractive prices, then it's usually a good use of their cash. But the bigger issue is that share buybacks are now being scrutinized more heavily by our leaders in government. In 2023, a 1% corporate tax on share buybacks was put into effect. But it's an issue that continues to be a hot button, with proposals out there to increase the tax up to 4%. But the other part of the criticism is that companies should either distribute that capital to shareholders as dividends or reinvest the capital into new businesses, innovation, or efficiency projects. And that criticism even came up in Apple's antitrust lawsuit with the Justice Department talking about how Apple spent more than double the amount on buybacks than they did on R&D. But I think part of the issue there is that Apple spent $30 billion on R&D. I mean, that's an insane amount of money. And when you do that, it also means you need the actual people to be able to execute against it. And you need enough ideas that actually have some chance of being viable in the future. So I think part of the issue is that these numbers are so big that people don't realize that it takes more than just money to make things happen. Whereas a share buyback adds value for shareholders, and it doesn't take teams of people to execute. And now my opinion on this is pretty simple. I see share buybacks as just another tool that a company can use to manage their business and reward their shareholders. And sometimes the best use of cash is investing for the future, and most high-growth companies do this, or companies like Amazon that have a culture of doing this consistently no matter how big they get. And sometimes the best use of cash is distributing the capital to shareholders as a dividend because the business is mature and established enough to do that. And it makes sense to just distribute those funds on a regular basis with the knowledge that the receiver is responsible for the tax implications. But I view buybacks in a similar way. Sometimes the best use of cash is rewarding shareholders in a more tax-efficient way by giving them a higher percentage ownership in the overall business at that moment in time. And it's a conscious choice by the company to say, hey, maybe we don't have a lot of high ROI project ideas right now, and while dividends are good, we don't want to permanently increase the cash distributions because they're only going to be expected to increase every year going forward, because we actually may need that additional capital in future years. And yes, they could do a one-time dividend, and some companies do that. But again, buybacks represent a more tax-efficient way to reward shareholders, especially if the company thinks the current share price is attractive. So again, it's going to be a matter of personal perspective, but for me, I view it as just another tool in a way to manage a company. And obviously, that's just my opinion. And the reality is that the opinion of our political leaders and others is that it is more controversial, and they're actively trying to discourage it. So the challenge for these companies is going to be figuring out how to best use their cash, knowing that a couple of the traditional avenues they've used in the past are likely not going to be available to them, or at least are going to be significantly harder or less efficient than they were before, either because of long drawn-out vetting periods for acquisitions or higher taxes on buybacks, which skew the cost versus value equation. But I think the point that I took away from this article the most was that some people would look at this as another obstacle for big tech, another reason why their run as the market leaders might be over. But I have a slightly different view. I mean, these companies are generating so much cash that we've now decided that the fact they have so much cash is a bad thing, and that's just not a view that I can take very seriously. So yes, obviously they need to have ways to use that cash for ongoing growth and innovation in their business. But at the end of the day, having a net $250 billion of cash is better than not having it. And the fact that those companies are in that position in the first place shows how strong and dominant their businesses are. And that's partially why I've continued to add them to my portfolio this year. So as investors, I would expect that they're still going to use that cash for things like share buybacks, maybe increased dividends, and maybe acquisitions. Now, some of those things may be harder, but at the end of the day, the cash is going to go somewhere, and it's likely going to be in a place that rewards shareholders. So we'll just have to see what happens. All right, now lastly, I wanted to touch on a couple of stock splits that were announced in 2024. Now, Walmart did a 3-for-1 stock split in February, which was the first one in over 20 years for the company, bringing their price per share down from about $180 a share to about $60 a share. And then Chipotle's board approved a 50-to-1, yes, 50-to-1 stock split in March. It's the first in their history, and it still needs to be approved by shareholders in June at the annual meeting. But it would bring their price per share from around $2,900 to around $55 to $60 a share. And now, obviously, we know that stock splits don't actually change the value of the company, although in general, it seems to help increase the amount of interest in a stock because more people can afford shares. Now, how much that actually matters these days because of fractional shares becoming more popular, I don't really know, but I did love this move by both of the companies, and let me tell you why. Walmart announced in their press release that a driving factor for the stock split is to ensure the share price remains attractive for their employees so that they can take advantage of the Walmart Associates stock purchase plan. And it's part of an ongoing evaluation by Walmart to make sure that the share price aligns with what Walmart Associates are making, so it incentivizes them to actually take advantage of the program and invest. And Chipotle echoed a similar sentiment in their press release saying, quote, "We believe this will make our stock more accessible to employees as well as a broader range of investors." And so in both cases, the company is splitting their stock to make it more accessible and attractive for their own employees to invest. And the reason why I love this so much is that both Walmart and Chipotle are going to have employees that are in that lower income range or in entry-level jobs. And so helping those folks learn how to invest and get incentivized to invest is one of the best things they can do for their overall financial situation. And it'll likely give them a higher sense of pride and ownership in their work and their job. And that's just kind of the icing on the cake. So I love this for Walmart and Chipotle. And obviously, many companies have stock purchase programs, but it's cool to see the use of a tool like a stock split, where the driving factor is to help their employees and folks earning lower incomes to start investing. And the reality is that employees investing in either one of those companies will likely do well over time, especially with incentives like the 15% match for Walmart. So yeah, it's a great example of how companies can help drive financial well-being for their employees, which hopefully will turn around and help the company in the end, because more good employees will want to stay with the company longer. So that's all that I have for you guys today, and I would love to hear your own stories about the worst stock you ever bought, so let me know what those are down in the comments below. Now, you may not know this, but I started a Discord recently, and it's just a few of us in there starting to build a community where we can share ideas and talk about stuff like this. So if you're interested in that, then click on this link right here. And if you're like, dude, just give me another free video, then check out the one that YouTube wants you to watch right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.